Hey guys, it's Milton Andrade again. I'm the broker of Franklin Realty Consultants, and I'd like to educate you on the kinds of mortgages that one would get in order to buy a house. Now keep in mind, I am not a banker, I am not a mortgage broker, but I was raised by one, and I've been doing real estate for going on 19 years now, so I know my way around the mortgage industry. Okay, that being said, take it with a grain of salt. If I say anything wrong, I'm sure you'll all correct me. So, there are three types of mortgages besides niche products and private mortgages and other exotic loans. You have the VA loan, government-backed loan for vets. You have the FHA loan, it's government-backed loan, first-time home buyers. And then you have conventional loans, which are technically also backed by the government, but for primary residence, vacation home, and investments. So let me cover FHA loans first. FHA loans are for first-time home buyers, which means whenever you don't have a mortgage, you are a first-time home buyer. You can own 100 properties with no mortgages and still be a first-time home buyer in the eyes of FHA. So it's not just a one-time thing, it's just one at a time, with a caveat. You can possibly have two if you're moved for work more than 50 miles. A banker can answer that better. In any event, FHA loans, you need a minimum down payment of 3.5%, and you can be one day out of school. As long as you're working within your degree, FHA considers school as work. Conventional does not. You need 2 years for that. So it's easier to qualify for students, and it's also easier to qualify if you've had some challenged credit in the past, as long as you don't have any open collections or debts of that kind, but you can definitely qualify. It's specifically made for first-time home buyers. The closing costs can be gifted by the seller. The down payment can be gifted by family. It makes it very easy for you to qualify to boost home ownership throughout the United States. Now, one thing a lot of people don't know is that you can also buy a multifamily 2, 3, or even 4 units with an FHA mortgage as long as it is your primary residence, and you will even get 75% of the rental income of all the units except one, because you're living there, to boost your income to qualify for the loan. It's no-brainer. That's what you should do. Set yourself up with an investment property first and use an FHA loan. VA financing is specifically for vets, have served in the military, whether it be domestic or overseas. If you've served in the military, you qualify for a VA loan. And a VA loan is a government-backed loan up to 100% financing. You still have to qualify, full doc, income taxes, credit, but 100% financing. It's fantastic. And it can be used all over the United States. So I highly recommend it for veterans. VA financing is for you. Now, on to conventional loans. Conventional loans can be for your first house, primary residence, your second home, vacation, or investment properties. These loans are also backed by the government, but to a differing degree. So you have a smaller amount of insurance for not the life of the loan like FHA, but for as long as you don't have 20% equity. So once you reach 20% equity, it can drop off, whether that be 6 months or a year. You can also purchase with 3% down, 5% down, 10% down, 20, 30. It all depends on the type of property that you're getting and the use. What's the intended use? But conventional loans are the majority of loans that people use to finance properties throughout the country, especially because they're less restrictive than, say, an FHA loan or a VA loan, where the property has to qualify as much as you do. Conventional loans are a little bit more jack of all trades, let's say. So let's cover condominiums, or as I like to call them, the red-headed stepchild for mortgage companies and banks. The reason why I say that is because if you'd like to buy a condominium with less than 20%, even as your primary residence, the condominium is going to be interviewed as strictly as you would for your mortgage. Condo has to fill out a condo questionnaire. So management has to fill out a condo questionnaire, which you're going to have to pay for. And they're going to have to answer a whole bunch of questions. And so, first, what kind of reserves do you have? Some states have reserve requirements, others not so much. If you have less than 10% reserves in any condo building, the bank will require that you put 20% down payment. There are some other loan products that will piggyback one on top of the other, and you can do it with 10% down if you have a certain credit score, but that's not standard conventional. Standard conventional would be 20% down unless the building has at least 10% of the total yearly budget allocated for reserves. Another thing, if you have more than 50% of the community owned by investor and thereby occupied by renters, you no longer qualify for that kind of conventional financing. It's going to be non-Freddie, non-Fannie approved lending. Another thing, you can't have open litigation. It could be a slip and fall, it could be a construction defect. It's just open litigation against the building or the condo board would make it very difficult, not necessarily impossible, but very difficult to qualify for any financing. And on a side note, any new building typically has 10 years guarantee on the foundation by the developer, and they have an insurance policy that would cover them over for any defects that you may find. And I'll tell you, buildings always find defects. And then there will be litigation against the developer within those 10 years, leading to no financing in the building for that period, unless the building attorney will write a letter stating that even if the building were to lose the case against the developer, that it wouldn't affect them in a negative manner financially. And they will never send that letter because that would weaken their case against the developer. So that doesn't mean the building is bad. It just means at the moment, because of the litigation, a bank won't necessarily give you a loan. So you have to kind of stick it out, and then all of a sudden you're out of it, and then you get a new lobby and a new pool and new money in the bank, and now you qualify for all the financing in the world. But those are the caveats for condo financing using a conventional loan or even an FHA loan, which up until recently didn't even do condos. They brought back the on-spot approval, but I will tell you, in my own personal opinion, if the condo qualifies for 3% down, 5% down, conventional financing, then it can qualify for FHA financing. But why would you use FHA financing that has mortgage insurance premium for the life of the loan if a conventional loan doesn't have that? One reason, because you can only qualify for it using FHA because of the credit score requirements or the debt to income ratio, which is a little bit more flexible than in conventional. So that's condos.